Good afternoon. I'm Michelle Nofel, Head of Distribution. I want to welcome you all to our City Different Investments quarterly webinar. On the call today from our investment team, we have Fixed Income Co-Portfolio Manager, Chris Ryan. From our Domestic Equity team, we have Rob McDonald and Connor Brown. And representing our global team is Senior Analyst John Lim. Both Shweta Singh and Vin Walden are traveling today, so they're not on the call. If you have any questions, please feel free to type them into the Q&A box, and we'll be happy to address them during the Q&A session. Starting us off is Chris Ryan, and Chris will be discussing the state of the economy. Chris, take it away.
Yeah, I wish I could discuss the state of the economy. We had a Fed meeting yesterday where the Fed left rates unchanged, and there were two dissenting votes. And supposedly that was the first time that happened since I think it was 1993. But it's understandable given the politics of the Fed board right now and who appointed those governors. The interesting thing was that before the Fed meeting, the market anticipated a September cut in rates at a probability of 58%. Immediately after the Fed meeting, that probability rose to 65%. This morning, after everybody got to read all their notes and everything, that probability is down to 42%. We are maintaining our neutral duration strategies in all of our SMAs, both taxable and tax exempt. We think, given the fact that it's hard to understand what's going on with tariff policy, trade policy right now, it's good to stay neutral, kind of like what the Fed said. Today we also had we had CPE come out, which is the Fed's favorite inflation measure. Last month was upgraded from 2.7 to 2.8 year over year, and this month that was 2.8. Just as a reminder, the Fed target is 2%, so we're well above the target. And when the full effect of tariffs is felt, we expect that number to move higher. Given that, our strategy in all of our SMAs is to stay in neutral duration ranges. We're overweighting the front end of the curve because all of our value metrics, the three we use, are pointing that is where the value is still located. And we're staying in with higher credit quality securities. In the municipal market, we've seen a couple blowups this last month or so. A fund group called Easterly saw their high yield fund decline by 50% over a short period of time, and the lawsuits have already started. We're starting to see cracks in credit, especially in the high yield range. And we think that may start to move into the lower investment grade range. And as we like to say in our latest blog, as we opened up, water's wet, the sky is blue, and credit risk is out there only getting stronger. And yes, I did take that from Bruce Willis's The Last Boy Scout. So I'll leave that with you. As I said, all of our value metrics point to the front of the curve still being a value. The one thing I would say is that those metrics are changing differently depending on the market. The municipal market is moving faster, curve is steepening faster than we're seeing in the Treasury market. So we're keeping an eye on that. We may end up changing strategies given the market dynamics. Michelle, I'll give it back to you.
Thank you, Chris. Now over to our domestic team. Rob, where are you finding value in the U.S. market?
Yeah, good question. So I think the main story about the U.S. market is just U.S. government policy and how that's evolving. I think that's sort of the big picture idea that everyone's following. And early in the year, it was really about tariffs and DOGE and what impacts they'd have. Those issues have I guess, subsided or become more benign. And the new area of focus is higher education, which means, the impact on scientific research or healthcare, and then immigration. Like those are all kind of all tied to cultural issues. It's cultural, it's economic. Um, but it seems that, the cases we have so far is there is an initial um, scary headline or potential policy, and then it gets moderated over time. So the spots that we're looking for value is, this sort of like what's the headline? What industry or stocks are getting impacted, and is there an overreaction? And thinking about that, we're thinking through healthcare. Um, you know, that's been an area that's has come under pressure. Longer term, it seems to be a very important and investable area. So we'll be looking to put money to work there, and also ideas tied to immigration or international students. Um, and then always we're looking at, public sentiment is very important when watching the government policy. There's lots of, there's trade deals. How are people feeling about them? How are they feeling about immigration? The big beautiful bill, um, it currently is viewed negatively. Does that, change for the better or the worse? And then also the 10 year, the 10 year is important for how, you know, that may predict some action by the government. So it's a lot of interesting stuff out there. We keep looking for good opportunities.
Thank you, Rob. Jong, will you touch on the global teams framework and talk through some of the themes that we like?
Yeah, thanks, Michelle. So obviously, we've been very pleased with Global's results so far, and we thought it's a good opportunity to explain like why it happened and kind of what differentiated us from our peers. Naturally, it's more interesting to talk about it when we're doing well. So let me talk about it. So fundamentally, we think there are three things that kind of differentiates us from our peers. The first one is obviously Vin's kind of investment framework, which is basically focusing on three things: business quality, not the traditional business quality, but in terms of like how well the business is in the industry, how it could perform over the long run, and obviously valuation. We get in when it's attractively valued, not when undervalued. It's obvious, but a lot of people don't think that way. And we look for catalysts that might kind of move things to the right direction. So obviously this investment framework, it's probably the most fundamental of what we do, and it probably wouldn't change much as long as Vin is in charge. So that's one thing that we want to emphasize, and it has worked. And the second one, which we think is also important, is we really hone in on a few global themes that we are quite sure about. We've talked about this multiple times, so it's like repeating. We don't want to repeat it again and again, but we want to repeat it again and again because it is something that we're quite sure about. So, for example, the energy transition theme, the e-commerce tech theme, that those two are what we think are quite stable, and we think it's gonna work for, I don't know, the next 3, 4, 5, 6, 7 years. So we try to apply this lens, this kind of global theme lens, and our investment framework, and really look for ideas that are super interesting that would give us good returns. Beyond that, I think finally the last, and maybe not the last, but another important thing that in my mind, what made us do so well recently is we actually really concentrated, and we have a long-term time horizon. So we're willing to hold on when we're right, and even if something has gone up a lot, if the fundamentals are improving and valuation hasn't caught up, we're willing to wait and let it go up more. So we actually hold on. We're willing to hold on. I mean, we might trim if it's too much of our portfolio when it's getting too big of a portion, but I think this willingness to stick to what we think we are quite sure about when things are improving, we see that as an advantage, like this long-term time horizon. But fundamentally, these are the things that we think are important, that we think our investors should know. And with that, I'll pass it to Connor to talk about why the weakness in U.S. currency could benefit foreign stocks.
Yeah, thanks, John. I remain super bullish on the mid cap space as Rob and I work on that area, though I am a guest appearing here to speak towards global trends for the moment in support of John and Vin. Just I think something that we should all be keeping track of is what's happening with the U.S. dollar. So the U.S. dollar weighted index had its worst first half of the year in 50 years since 1973 so far this year. I think the important drivers of that have been tariffs, tax cuts, and future deficits. It's really a tax and spend bill is where we landed in the end, with potentially large future deficit impacts, and some real political pressure to cut rates on the Fed chair. Now, will that be effective? Will that backfire? I do know that current administration would sure prefer a more dovish Fed than we have currently, which I think probably does put some pressure on interest rates and the dollar. I will mention that we've seen a bit of a rebound on what look like some actually very good trade deals that we've announced recently, especially with the EU. So a little bit less tariff than perhaps some had feared, and some would look like pretty good outcomes for U.S. and some of those trade deals has relieved some of that pressure. But I think the sort of the structural fundamentals underpinning a weaker dollar so far this year are probably likely to continue into the future. And I think financial advisors broadly, as we go out and we meet and talk to them, are way underweight ex-US securities. This might be the beginning of a good reason to increase international or global exposure in client portfolios. Okay, that's all I got, Michelle.
All right, it's time for our question and answer session. So if you do have some questions, feel free to type it in the comments box and we will address them. So let's see. First question we have here is for the domestic team. What stocks in your portfolio have outsized exposure to policy decisions coming out of Washington?
Yeah, so we have a few. Overall, we try to be balanced in our in the portfolio, not too leaning or making a big policy bet. I think our biggest position is Flex, which is a contract manufacturer. So they manufacture products for other companies, and they're manufacturing all over the world, and so they're tied to tariffs and how products can trade from place to place. And so overall, for a while people were concerned about that. I think overall they probably benefit longer term because everyone needs help. As trade and supply chains get more complicated. And then Grand Canyon Education, which is it's a for-profit education company. Historically, it's been I think it's probably got a discount, and there was concerns about regulation. But with this administration, it seems almost quite the opposite. Whereas the government's going after sort of Ivy League schools, and this is very much the opposite, and should be a beneficiary.
Okay, this question is for Chris. What happened to the long-touted summer seasonal rally in the municipal bond market?
It never showed up. We've seen a lot of supply in the municipal market. Typically, we look at 10 billion per week as being the cutoff between munis doing well and not doing well. And we have had multiple weeks of $10+ billion of supply. Why? I think issuers were concerned about higher rates and inflation and therefore decided to come to the market when they could. We think this is going to pull forward a lot of the supply issuance we typically see in September and October. So munis should be set up to perform well into the third and fourth quarters of this year.
Okay, this question is for Chris as well, from a fixed income manager's point of view. When will the market see tariff impacts on inflation?
That's a great question. And the Fed asked it yesterday a few times. We think it's going to be in the third and fourth quarter. It's been quite chaotic. I mean, we had today, for example, Mexico gets another 90-day reprieve. If you're a manufacturer, it's really hard to figure that out. I mean, think about it this way. I heard one economist put some numbers to it. It takes 2.5 months to take product from the Far East to California and unload it. How many companies front-end loaded all their purchases in the first and second quarter to beat the tariffs? And now they're bleeding through that inventory. So we think it will have an impact, and we think we'll see it in the third and fourth quarter. We saw a little bit of an uptick in core PCE today. I don't know that that can be attributed solely to tariffs, but we think it's on the horizon. And if it doesn't show up, it'll be a pleasant surprise. I mean, the question is, who's going to pay the tariff? If it's the producer, well, then I think you can expect margins to suffer, and that may have an impact on the stock market. And if it's the end user, the consumer, you're going to see that reflected in higher inflation numbers, neither of which is good for the financial markets.
Is there still value in overweighting the shorter end of your SMA investment universe? And what metrics do you use in evaluating this strategy?
We think it does make a lot of sense. As I said, the markets are changing at different rates of speed. But for example, one of the metrics we use is we look at the ratio of income, of yield between a 5-year and a 10-year security. Right now in the Treasury market, if you own a 5-year Treasury bond, you're getting 90% of the income of a 10-year Treasury bond for only 49% of the duration risk. We think that's a great value. The long-term average is 77%. In the muni market, you're getting 77% of the income of a 10-year AAA muni with a 5-year AAA muni. The long-term average is 67%. And again, in that market, you're only picking up 55% of the duration of a 10-year. Again, a great value by our way of thinking. The other metrics we use is look at the slope of the yield curve. And we use that, the slope we use is to define that as the 2s-10 spread, 2-year maturities versus 10-year maturities. In the Treasury market, that slope is 41 basis points. Long-term average is 97 basis points. So you still have a long way to go in steepening to achieve that average. In the municipal market, it's a steeper yield curve, about 90 basis points, 2s-10s. The long-term average, though, is 150 basis points. So again, to achieve long-term average, you're going to have to steepen a great deal. That's the other metric that we think is important. Finally, and this is the one that's giving off conflicting signals, is looking at real yields. In the Treasury market, real yields are all positive, but relatively speaking, 5-year real yield is more attractive than a 10-year or a 30-year. In the municipal market, it's all over the place. So that's why we're watching the municipal market a little more closely to decide if we're going to change our strategy.
All right. Well, that wraps up our question and answer session. Thank you for joining the call today. As always, I'd encourage you to check out our website. We have a blog section and we've been posting a lot of new content there. So again, thank you for joining, and we look forward to seeing you next quarter, and feel free to reach out if you have questions. Thanks so much.